Hey, just in case you have forgotten your DCF valuations, if you want them for feedback, are due by Friday. I won't put a time, sometime Friday. Okay. But I hate to be the bearer of bad news, but you know what's coming up next Monday, right? You have no idea. Second quiz is next Monday. You say, but you have no time. If you've been working on your DCF project, you in a sense been working on them, the bulk of what the next quiz is going to be, which is everything from growth to all the mechanics of valuation. So your next quiz is next Monday. So first 30 minutes, same kind of rules as the first quiz. So just to get you ready. So I'll put up the review session and the past quizzes up today. So it'll show up. I'll send it as a link on your email. It'll also be on the webcast page for the class. So when you get a chance, you know, when you feel you have enough time to open it up, you're welcome to. So today I want to talk about valuing individual companies. As you remember in the last session, I did a valuation of Con Ed, used it as a vehicle to talk about using DCF values to get target prices. You take the value today and you forecast out what the price will be 1 year from now, 2 years from now. And then I looked at 3M and how a crisis can change your valuation for a company, even though none of the numbers change. So today I'm going to continue with that. I'm going to talk about valuing the S&P 500, and then I'm going to go off into the deep end. I'm going to we're going to embark on what I call the dark side of valuation. It sounds mysterious. It's about difficult to value companies. But today I want to start with a couple of questions. One is very closely related to what you're doing right now. So value your company, you're going to get a value per share. Unless it's a very unusual valuation or you've played games, your value per share is going to be different from the market price. Let's take that as a given. How different is going to vary across companies, but you got a value, you got a price, and you're trying to explain it. So let's go through the explanations and you tell me which one you would attach the most meaning to. First is you are right and the market is wrong. That requires a particularly large ego, but maybe that's where you will end up, right? It's a very dangerous place to be, which is you feel that you own the high ground and everybody else is stupid. Think of all those other people in the market is saying. The second is you're wrong and the market is right. If that's where you end up, essentially that's where you end up, because you know where the end game then is, right? At the end of this class, this will be the last valuation you ever do, and you're going to put your money in index funds, and you're saying, why am I wasting my time? It's an incredibly useful, productive result of the class, because think of how much money and time you're going to save not chasing after dreams. But it does mean that your valuation career is going to be over on May 8th. You're done. The third is you're both wrong. That actually is the truth. The market doesn't have some magic crystal ball. Think of it as Yelp review for a restaurant versus your review, right? Yelp review is not always right. I've gone to restaurants where I said, really? This got a 4.8 stars? I don't believe it. Okay? You're both wrong. And what you have to hope is you're less wrong than the market. That's really what this is not about being right. Because we're all making guesses for the future. Who knows what the future will bring? You can't obviously both be right. That's a one choice that's off the table. But you can both be wrong, and you're saying, please, God, let me be a little less wrong than the market. That's what we're hoping for. So don't put the weight of the world on your shoulders. And at the end of your evaluation, how do I know I'm right? Because you're not going to be right. You're going to be wrong. But you brought down the temperature and said, no, I don't have to be right. I just have to be less wrong. There's a second question I would ask, and this is kind of a kind of a technical question. How many of you are valuing young companies? Anybody valuing a young company? Okay. What do your cash flows look like in year 1, year 2, year 3?
Cash flows are negative.
They're negative, right? Now, when you get negative cash flows, what are we implicitly assuming the company is going to be able to do?
Due to some magic, the investment and having more market share.
No. This is not all the market share stuff is already done. It's in your revenues, it's in your margins. But I'm asking about that negative 1 billion in free cash flow you get in year 1. To get to year 2, what does and to get all of your future, your nirvana to come through, what are we implicitly assuming? That capital is coming into the firm. Are we assuming some mix of capital? You are, right? In your cost of capital, you tell me your debt is 5%, your equity is 95%. You're implicitly telling me you're going to raise capital, and a big part of it is going to be new equity, which means you're going to issue new shares, right? But here's what I did in your valuation to tell me whether I've messed up. I took the present value of your cash flows. I came up with the value of equity today, and then I divided by what? The number of shares you have. Seems like I've left a gap, right? Because to cover those negative cash flows, will I not have to issue new shares in the future? I will. So how come I'm ignoring them? I'm actually doing the right thing, but tell me, because this is a question you're going to get asked. Why aren't you adjusting your share count for the fact that you will have to issue new shares in the future of your young company, and there will be dilution? Why are you not doing it? But that doesn't fully answer the question. You still have to ask, the value is based on your forecast for the future. So if you're projecting everything else in the future, shouldn't you also be factoring in the increased share count you will have? Still not a good. I mean, it's bringing cash in, but complete the process. When I did my DCF value, what did I do? I took your cash flows, including the negative cash flows in year 1 and 2 and 3. And because I had big negative cash flows, what did I do? I lowered the value of equity for those negative cash flows. That's a dilution effect already embedded in your present value. If I now divide by the shares outstanding with the shares that I'll be issuing in the future, I'll actually be double counting. So when you do traditional discount cash flow valuation, this is a blessing because you're not going in the circular logic of how many shares will I issue in year 1, year 2, year 3. It's already in there. And people say, where? Here's the simplest way to show it. Compute the value without those negative cash flows in the first 3 years. Compute the value that you got with the negative cash flows. You're going to get about, I'm going to do Amazon today in 2000. I'll get a value about 20% lower because I counted the negative cash flows. That's the dilution effect already embedded. And it saves us a huge amount of torment of trying to, because think of otherwise what you'll have to do. You'll have to estimate what the price per share will be 1 year from now, how many shares will be issued. Now, you don't want to get into that cycle, but if you do a discounted cash flow valuation right, the dilution is already embedded in your value. Yes?
That only seems to work when there's negative to positive, not back to negative, or does that?
It works no matter what, right? So if you go negative, positive, back to negative, remember when you do a discounting, what are you doing with the positive cash flows? You're removing from the company. You can't assume the cash flows stay in the company, even though they might decide to do that. If you discount the cash flow, you're effectively removing it from the company. So you're leaving it with a zero cash balance. And then if you have a negative cash flow in year 7, you have to come up with the whole process again. Now, in practical terms, what the company will probably do is they will not give you the cash flow, in which case your effective cash flow will be zero in that year, that positive cash flow year. They'll keep the cash flow to cover the negative cash flow because it's more practical. You save an issuance cost. But that's the nice thing about doing DCF right, is you are already factoring in dilution. You had a question, Dor? I'm sorry.
When we are raising more by issuing more shares, we are raising more equity, and then we are raising more debt as well. So
Only but you said that, right? Nothing in your valuation comes from me. When you gave me a debt ratio using the cost of capital, you were telling me how you were raising capital. So if you don't like the fact that I'm using a lot of debt, all you need to do is go into your cost of capital and reduce your debt ratio over time. And I'll say, okay, nothing in your valuation. So what I'm trying to say is don't blame me for whatever your value is. It's coming from one of your assumptions. If you don't like it, go and fix the assumption. But there's always this open question. What if a year from now, I'm unable to raise capital? You see how that can happen? We're right now in a VC freeze. There's talk about how Silicon Valley Bank is going to make it even worse. You're a young company. What did you assume? You'd assumed a year from now, 2 years from now, 3 years from now, there'd be VCs coming in with capital, risk capital. If it's not there, guess what happens? What happened in 2001 when the dot-com boom bust? 95% of dot-com companies ceased to exist. That's why I put in the failure rate. So when you have companies with negative cash flows for the first 5 or 6 years, one of the things I would expect to see in your failure rate is a higher failure rate, simply because you have to leave open this possibility that even though things might look good now, they might not look good 2 or 3 or 4 years from now. Companies with cash burn are more exposed to that risk than companies without that cash burn. Okay, so let's go back, and today we're going to start the session. It looks awfully dark. You guys are going to fall asleep here. You're nursing a hangover, I'm sorry, but I have to have the lights on. So today we're going to start with an unconventional valuation. We valued Con Ed, a company. We valued 3M, a company. And each of you is valuing an individual company. But can I value an entire index using a discounted cash flow model? I don't see why not. When you buy the S&P 500, what do you effectively buy? The 500 largest market cap companies in the US in proportion to their market value, because that's how the index is constructed. If you did actually buy all 500 companies in proportion to their market value, would you be getting cash flows from those companies? Absolutely, right? And if I wanted to do this the long way, I could compute the free cash flow of the firm for each of the companies, add them all up. But that's going to be tedious and incredibly messy because they have different growth patterns, mature companies, growth companies. So I'm going to cheat. Here's what I'm going to do to value the index. This was on September 20th of 2022, but I have an updated version from January 1st, 2023, which you can bring up to April 1st if you want. Wait a couple of days, do the valuation again. So I'll take you through the process so you could replicate it, because this is a question you get asked all of the time, especially if you're viewed as somebody who does valuation. Is the market undervalued or overvalued? I'll tell you upfront, I don't like going there because it's not my investment philosophy. Because when you say the market is undervalued or overvalued, you are a market timer. And I don't think I have the ammunition to be a successful market timer. Why? Because with individual companies, you can talk about doing more research, having fresh insight, seeing something in a company that nobody else sees. I cannot make that statement about any aspect of the index, especially an index like the S&P 500, most tracked and followed index in the world. But if pushed to the wall and say, can you value the index? I'm going to try. So let's start. To value the index on a discounted cash flow basis, I need expected future cash flows, right? I could go the full route and compute free cash flow to the firm for the entire index, but it's messy because I have banks in there, I have insurance companies where computing free cash flow to the firm is going to be difficult to do. So I'll admit I give up front trying to compute free cash flow. And here's how I'm going to cheat. I'm going to look at what these companies collectively returned as cash flows last year. Let's not get ambitious. Let's look at what they returned. What am I implicitly assuming? That while some companies might return more than they can afford to, and some companies can return less, collectively, companies are not going to do crazy things of returning 50% more. So to estimate how much they returned, I looked at how much they paid as dividends. The old-fashioned way was that's the only way companies return cash. But if I stop there, I'm underestimating the cash flows equity investors collectively receive from companies. Because if you look at 2022, I think 2/3 of the cash flows returned took the form of buybacks. So what I started with was dividends and buybacks in the most recent year. And the question I have to ask is, what will those numbers look like in the future? So I'll frame the valuation. September 2022 was a particularly tricky time. Inflation had come back. People were starting to talk about recession for the first time. And they're saying there's going to be a recession. They blamed the Fed, of course, but the recession was coming because inflation was out of control. So here were the big questions that I was looking at in valuing the index. First is, I'm not going to be projecting earnings for individual companies. So I'm going to cheat and look at projected earnings that analysts have for the index. And there are, I think, about 12 or 15 analysts who track the entire index, and their entire life is forecasting earnings for the index, the collective earnings. I had access to those numbers, just like each of you has. It's publicly available. So the first question I had was, are analysts incorporating the effect of an expected recession into earnings? Because we know earnings is going to be. So I want to start with that question. Second, I wanted to also think about what inflation would do to my discount rate. We know as inflation goes up, interest rates go up. But we also know that as inflation goes up, the uncertainty about inflation increases, risk premiums go up. So the three big questions were, are the forecasted earnings that I'm seeing for the index over optimistic because they're not factoring in a recession? What will happen to the percentage of those earnings that get returned in cash? You're saying, why would that change? Remember that companies return more cash when they feel comfortable and the economy is doing well, and less cash if they feel uncertain about the future. So if I can answer those four questions, in effect, I can value the index. See, here's what the base year numbers look like. Analyst projection for earnings in 2022 was 225.3. Analyst projections are always in what I call index units. The reason index units are different from what you look at billions of dollars is you have to convert it all into the same number of units of the index. The S&P 500 is at whatever, 3,875. Then everything has to be converted from whatever the actual dollar value is to those units. So 225.3 is the expected earnings in 2022. 243.5 was the expected earnings in 2023, according to analysts. My job, if I'm valuing the index, is to say, are those too high? Is a recession going to lower those? The T-bond rate, at the time I looked at it, was about 3.8 something percent. Said, will that go up or go down as inflation goes up? So effectively, those are the questions I'm going to frame my valuation on. So let's start with what analysts are projecting in earnings. So what you see in this table is analyst projections of earnings in 2022 and 2023 by month of the year in 2022. Remember, at the start of 2022, nobody was talking about a recession. In fact, the talk was upbeat. People were talking about how the economy is going to come back stronger. What I was trying to figure out is, as I went from January 2022 to September of 2022, were analysts getting more pessimistic about future earnings as talk of a recession went up? You can decide for yourself, but if there's an effect of a recession on these expected earnings, you can hardly see it. It's almost like analysts live in a different universe than macroeconomists are forecasting recessions. I'm not saying analysts are wrong. Macroeconomists are just as likely to be wrong, but at least from the perspective of analysts, if there's going to be a recession, it seems to be an earnings effect-free recession. The earnings don't seem to be reflecting much of a change. File that away, because you're going to get a chance to come back and say, maybe they're wrong. Maybe they're overestimating earnings. So that's the first step. Second, I looked at what percentage of those earnings had been returned to investors in dividends and buybacks every year in this century. I don't want to go back to the last century because things have obviously shifted away in how cash gets returned. So starting in 2001, I look at the percentage of earnings that gets returned in dividends and buybacks. So in 2001, that percentage was 41%. But as you, I'm sorry, it was 77%. But as you go through time, you can see there are years in which that number has exceeded 100%. And on average, across those 22 years, you get about 80 to 85% of cash flows being returned to investors. Again, you can say that's too high, that's too low, but that's what the pattern of cash flows has been, or cash return has been over the course of this century. You get a chance to make a judgment of what will that be going forward. So you can see the earnings from analysts, you can see the cash return. So I'm going to give you my S&P 500 story, and the emphasis is mine. You could look at the same numbers and come to very different judgments, but in September 2022, here's what I forecast. First, I looked at those earnings, and my belief was that analysts are underestimating the impact a recession will have on earnings. By how much? I forecast a drop in earnings of about 15% for 2023 from the recession, and a spillover effect into 2023, into the following year as the recession wanes. So my earnings numbers are going to be lower than the analyst estimates because I think a recession will damage those earnings more than analysts are forecasting. You might look at the same numbers and come up with an even bigger cut if you feel the recession is going to be deeper, or nothing at all if you feel there's going to be no recession. For the cash return, in the 12 months leading into September of 2022, companies have returned about 90.5% of the earnings in the form of dividends and buybacks. I don't think they can sustain that, especially as they get more uncertain about the future. I think that number is going to trend down, not overnight, but over the next 5 years, down to 80%. So I'm projecting lower earnings than analysts. I'm projecting less cash returned. And then in terms of the discount rate, in September 2022, I felt that the bulk of the inflation increase had already been built into T-bond rates. Now you can see why your valuation can be different from mine. If you are more bearish on inflation staying high, you might say that's not true. I think T-bond rates could end up at 6%. I think 4% is about where we're going to end up. So I felt the bulk of the inflation had already been built in. So I left the T-bond rates pretty close to where they were in September 2022. And finally, if you look at the equity risk premium, the equity risk premium, I use this framework to compute an implied premium. Here I get to make a judgment on premiums. Because if you just use the implied premium, you know what you're going to find, right? By definition, implied premium gives you a value equal to the index. Here I'm trying to value the index. I used an average, the premium of 5%, which is close to the average equity risk premium just in this century. If I go back to 1960, that premium is much lower, but I don't think we're going to go back to that lower premium. So collection of assumptions, lower earnings, less cash returned over time, a T-bond rate that's going to settle at 4%. So I don't see this bullish view of T-bond rates going back to 2%, and equity risk premiums of 5%. Yes.
In this example, the terminal year, returning to, so when you're forecasting a recession,
right,
essentially doing 5 years to the terminal year, okay, at that point, but then expecting
you're smoothing out, because there you're using a growth rate equal to the risk-free rate, which means there'll be recovery years after that year, recession years. And because you're not able to forecast that's why when people look at my terminal growth rate, they complain that it's too low. I say it looks too low because you're thinking about good years, but there will be bad years. And over time, I'm smoothing it out and using a growth rate that they can sustain in perpetuity.
Your equity risk premium in your terminal year is similar to your premium in your recession.
I'm solving for, in other words, I could change that. I could give you a second shot. That doesn't have to be. I've left it at 5%, but maybe I can give you a second shot. Say, in your stable growth, do you want to use a lower premium or a higher premium? So it's an input you can add on. So I did not here, so it's 5% all the way through. So with those assumptions, the value that I got for the index was about 35.15. I was surprised it was as close to the index value as I got. And you know why, right? Because people always think about analysts driving the market. If analyst numbers were, if I did not build in that drop of 15% in earnings, I would have actually ended up with 3,800 as my valuation. You know what this tells me? Markets have their own views about earnings. What analysts are telling you might be what you see out there on CNBC or on the Wall Street Journal. but market projections of earnings are often much more realistic than what analysts are projecting. But this is a framework you can use to revalue the index. At the start of this year, I valued the index, and I did actually 4 scenarios, one of high inflation and a recession. Think of that as your worst case scenario, stagflation. One of low inflation and a recession. One of low inflation and no recession, which is the most benign scenario. And one of, basically high inflation and nothing happening, basically, which is that we live with 5% inflation. What's the big deal? I get values for the index ranging from 3,400 as I think my low value to 4,300. And this year we've been moving between 3,800 and 4,200 each month. So you've got January where everybody's upbeat. The benign scenario looked like it was playing out. We were at 4,100. February, people woke up terrified, moved back down to 3,800. I have a feeling that you're going to see this band play out through the course of this year because nobody really knows what the end result here is going to be. But inflation and the economy, in spite of the banking crisis, inflation and economy are going to stay front and center in where the market goes. So any questions on valuing an index? Can you value the Sensex or the Bovespa using it? I don't see why not. It's going to be messier because what you will lack is that top-down analyst estimate of earnings. You might have to do bottom-up estimates, which are messier, but the process stays the same, right? Take the index cash flows, apply the same process that you use to value an individual company to value an index, and you can make the same kind of judgment about any market and any index that you choose to value. I want to do this with a banking index because I want to know whether the collective response to SVB has kind of made banks collectively undervalued. There, I'm willing to take a stand on my valuation, because we know what panic does to sectors. So maybe backing out what the fair value of the banking index is with reasonable numbers about what this will mean can be a good way to get past the smoke and the noise that's been thrown up because of the banking crisis. And in fact, when I did my September valuation, I did compute what the value of the index would be as a function of what my risk-free rate would be, because the reason I did this was I knew I'd get pushback from people with strong views on rates. Rates are going back to 2%, rates are going back to 6%. I don't own the high ground. I've used 4%, but it's my estimate. And with equity risk premiums ranging from 4%, which is the long-term historic average, to 5%, which is what I used, to 6%, which has been at the upper end of the risk premiums for the last 22 years. So you tell me your story for the economy and inflation. I'll pick a number there and say, that's a number that best fits your story. And you should probably act consistent with that story then, because your story and numbers will match up. So now let's move to what I think is the real reason for even spending a class in valuation. I'm going to call this a dark side of valuation. It's the title of one of my books, and I'll give you a history of how I picked that title. But the dark side of valuation is basically a reflection of the fact that some companies are more difficult to value than others. In fact, to frame this entire section on the dark side, which is the rest of my intrinsic valuation sessions, I'm going to talk about the 4 questions. And I brought these 4 questions up in the very first class that you need to answer to value any company. So as you valued your company, implicitly or explicitly, these were the 4 questions you needed to answer. First is, what are your cash flows from existing investments? If you're a young company, the answer is not much, but you can see it varies across companies, mature company or young company. Think of that as the easiest of the 4 questions to answer because you can look at the current financials, the current earnings, the current cash flows. The second question, in my view, the most difficult question to answer in valuation is, what is the value that is added or destroyed by future growth? Notice how I phrase that. I didn't ask you, what's your future growth? Because we know growth has a good side and a bad side. The good side of growth is it makes your revenues and earnings higher. The bad side of growth is you have to reinvest to get that growth. The net effect can be positive or negative. And I'm asking for your company, what is more likely? Which means you have to understand the barriers to entry, the competitive advantages, the business your company is, and what competition it might face. The third question I'm going to ask you is, how risky are the cash flows? Notice I didn't ask you, what's your beta? Don't mistake models for end questions. Even if you don't like the CAPM, you don't like betas, you still have to deal with risk. You still have to incorporate the effect of risk into value. And finally, I'm going to ask you, when will your company become a mature company? And why do I need the answer to that? Because that's when I put closure, and I put a terminal value. So if you think about evaluation, it's answering these 4 questions that leads you to a value. So I'll start by making an obvious statement. When those questions are easy to answer, valuation becomes easy. So if you're valuing a company with a long history, Con Ed, why are those questions easy to answer? Because it doesn't have a whole lot of competition. It's got a long history. It's a regulated utility. Each of those questions becomes easy to answer. If every company you valued was like Con Ed, you don't need this class. But worse, I don't need you. You see why? I could get ChatGPT to value every company, right? It's mechanical. If it's mechanical, a machine can value a company much more efficiently than you can. So be thankful for the dark side. The dark side of companies where these questions are difficult to answer. What kinds of companies will fit that? If you're valuing a young company, and we'll go through this in detail, each of these 4 questions becomes equivalent of pulling teeth. Painful. If you're valuing a company that doesn't fit the accounting mold, valuation becomes more difficult because you got to move things around, right? R&D has to be capitalized. All the numbers have to be restated. And finally, if you have a company with significant truncation risk. What's truncation risk? Well, normally when you think about cash flows, you think about being wrong. Your year 3 cash flows are wrong, right? You know what truncation risk is? Will there be a year 3? That risk is difficult to incorporate into traditional valuation. So companies which are distressed, companies that face nationalization risk, companies that face a regulatory crackdown are more difficult to value than companies that don't. That's a whole host of companies in those 3 groups. So let's talk about what it is about companies that are difficult to value. And I'm going to hit a whole host of companies in this session and the next one. I'm going to start by talking about valuation across the life cycle. Why are young companies so difficult to value? What are the challenges and how do you overcome them? Mature companies you think are easy unless they're going through a restructuring, but they're going to change their business model because the history no longer is useful. And declining companies are downright depressing to value because you're asked to do things that don't come naturally, put in a negative revenue growth rate, margins that decrease over time. It goes against human nature to be that pessimistic, but you have to be. So we're going to talk about those 3 groups of companies first. Then I want to talk about the challenges in valuing emerging market companies. I'm going to argue that 90% of what you do in emerging markets has to look like what you do in a developed market. You can't change the basic drivers, cash flows, growth, and risk. But there are estimation challenges with emerging markets related to cross-holdings, related to regulatory overlay, related to government interference that are more difficult. And you got to deal with those. And finally, I want to talk about valuing companies in different sectors. Right now, you know the sector that should give you nightmares to value, it's banks. Think of what, right? Right now, everything is in motion. You know, regulatory changes are coming, capital changes are coming. The way banks are run is going to be different. So I'm going to talk about valuing banks. Why I used to say banks are the easiest of all companies to value pre-2008. What happened in 2008 to change my mind? How I changed the way I valued companies after 2008, and how 2022 might cause more changes in the way we value banks. I want to talk a little bit about commodity and cyclical companies. What makes them different? Even the most mature oil company doesn't have stable earnings. You know why? Because oil prices move. The difference in commodity and cyclical companies is there's a macro effect on your earnings and cash flows that will dominate the micro effects. And you got to talk about what do we do differently then? If you're worried about oil prices all the time, how do you factor that into your valuation? And finally, I want to talk about companies with intangible assets. I'm going to go back to what we did with R&D, but I'm going to actually take a company and value it with R&D capitalized and without capitalizing R&D, so you can see why we bother doing it. You're going to see the shift in value you get when you do the right thing. So let's start with young companies. So I'm going to make you an entrepreneur. You've started a new business, lots of promise. And you've asked me to value a company. So I come in ready with my 4 questions. Ready? So the first question I ask you is, what are your cash flows from existing assets? What's your answer going to be? What existing assets? I don't even own the chair I sit in. That was easy. Let's move on. Now I ask you, what's your value from future growth? You say a lot. Can you be a little more specific? Not really, right? You don't have a product. You don't know what market you're going after. Then I ask you, how risky are you? Very. But beyond that, what can you offer me? There are no betas, price, so there's no historical data. And I ask you, when will you be a mature company? You fall out of your chair laughing. You don't even know whether you'll make it through tomorrow. You don't have enough cash flows. Now do you see why people don't even try to value young companies? Every single question becomes a nightmare to answer. So what do VCs do? They price companies. I've never met a VC who can sensibly value something. But that doesn't seem to matter, right? You price things, you sell it to a higher price, you're a successful VC. So let's talk about making this even more challenging. So young companies are difficult to value, but they get even more difficult to value if you're in a sector where every other company looks just like you. All young companies, all money losing, all with small revenues. Because effectively, I've taken away all your ammunition, right? When you sat down to value a company, think of what the first thing you reached out for. Last 10K, last annual report. Second thing you looked at was the company's history. We had access to S&P Capital IQ. You downloaded that data. Third thing you looked at was industry averages. Why? Because you wanted to get a sense. What happens to my company as it gets larger and more mature? Think of what I've done in this scenario. I've given you a young company. It has no history, so that's gone. You look at its current financials. There's very little you're learning about the company because it's losing money, not much in revenues. Saying that's okay. I look at the industry averages. But if every company looks just like yours, you're learning nothing from the industry averages. You have no financials, no history, no comparables. This is the trifecta you want to avoid in valuation because in a sense, you're in a nightmare scenario. And when you're in this scenario, the dark side will beckon. You know what the dark side will say? Things like, oh, valuation doesn't matter in AI at all. Valuation always matters. The fact that you cannot value something doesn't mean it stops mattering. But you'll also see these devices used by people who can't value young companies but want to invest in them anyway. First is, they'll talk about paradigm shifts. You know what that means? I have no idea what's going on. So I'm going to call it a paradigm shift. In my lifetime, I've seen at least 5 paradigm shifts, which have been neither paradigms nor shifts, because they seem to shift back 2 or 3 years later. I was told in 1999, there will never be a recession again. I'm not kidding. Go back and look at news stories from 99. People are convinced that technology had solved the recession problem forever. Why? Because technology, you don't have the kinds of booms and busts here with manufacturing. It sounded credible in 1999 as markets were booming. Paradigm shifts. Second, whenever you ask somebody about a company, rather than talk about the company, they talk about macro stuff. Why should I buy Rivian? Electric cars. Everybody's going to have electric cars. Why should I buy, whatever, Snowflake? Because cloud computing is here to stay. If you don't believe me, just watch a Kathy Wood interview about all of the companies, and every single company she's asked about, she gives a macro story. You're saying, what's wrong with that? Could the electric car market be huge in 2032 and Rivian be a terrible company? Absolutely. Telling me a macro story just takes me half the way. You got to complete the story by saying, this is why I think this company will benefit from that story. I still remember in 2014, Alibaba went public. And for those of you not familiar with Alibaba, Alibaba pulled off an amazing feat. It beat Amazon head to head in China. And essentially, it beat all comers because in 2002 or 3, it was a tiny company. So in 2014, it went public. And at the time of the IPO, one of the biggest IPOs of all time happening on the NASDAQ, I decided to value the company. So it's still on my blog if you want to go check it out. So I valued it and I called it the China story, not the fake China story where you throw in China after the fact to get a premium, but a true China story. Why did I use those terms? Because I went back and looked at why Alibaba won in China. And I think they won in China because they understood that the Chinese consumer was not like an American consumer. I'll give you, in fact, if you want to see Alibaba at play, open up a Google page, right? You get that box in the middle, nothing. And that's what you're taught in the US. Don't mess up the page. Keep it simple, focus people's attention. One box in the middle, you enter what you're looking for. That's a Google page. If you get a chance, also open the Taobao page, which is the entry point. You'll have to wear sunglasses, right? You get hit with 15,000 things coming at you at the same time. And I think the perfect description for what Alibaba did to succeed was what the economists called them in 2014. They called them the online bazaar. Have you guys ever been in a bazaar? Nice organized places, right? The exact opposite, it's chaos. But if you grew up in Asia, you grew up with bazaars. I still remember my mother coming here for the first time to shop, and she would stop and start bargaining with shopkeepers. And that doesn't work here. You can't offer 25% less at B&H Audio and expect them to take your offer. But that's what you used to. And Alibaba, in a sense, tailored a company that basically looked at what Chinese consumers. In fact, in those days, Chinese consumers would not leave their credit cards online because they worried about fraud. So Alipay was created to allow customers to say, look, you can shop here, you don't have to leave your information. And it succeeded immensely. By the time it went public, Alibaba had about 10 billion in revenues. That doesn't sound like much, but they had a 50% margin, money-making machine. So I valued them as the China story. I put in a 25% growth rate, which was what the Chinese and also 75% of all online retail traffic in China went through an Alibaba site. So clearly dominated the Chinese online retail market. They'd mastered the market. So in valuing it as the China story, I gave it a growth rate of 25%, which matched the growth rate of the Chinese online market for the next 5 years and then scaled down. But I did not let them have a growth rate higher than that, because what made them succeed in China is unlikely to work even next door in India. It's a very different market. So in my valuation, I gave them a China story, but it had legs. You let revenues grow at 25%, you leave margins at 40 to 50%. The value that I got for the equity of Alibaba in 2014 was 165 billion. That time, the highest value had ever attached to a company going public. So I come up with that value. CNBC calls me and says, Alibaba is going public in a couple of days. Would you come in and talk about Alibaba? And I say, yes, bad mistake. I show up. They put me in a green room. I don't even know why they call it a green room. It's neither green nor a room, but it must be some carryover from some history. And I'm sitting there waiting to go on. And this guy comes in. I recognize him as an equity research analyst. I almost feel the urge to flee, but he comes in anyway. And says, what are you here? I'm supposed to talk about Alibaba. I said, me too. I said, okay. So you get on. And I say, I value Alibaba at 160 billion. He says, it's worth at least twice as much. I said, why? He says, China. I said, what does that even mean? My entire 160 billion is coming from China. There's no other country in the world we could get this higher value. But that's a macro story. All you do to justify a company is electric cars. How do you push back against this? Of course, electric cars are big, China is big, but you can't use that as an explanation for any value. But that's the dark side. Use a big story to justify whatever you pay. And finally, you see metrics in these companies you've never seen before. The dot-com boom. For the first time, investors were dealing with young companies, money-losing companies, small revenues. None of the traditional metrics work. You know what I mean by metrics? Things like price earnings ratio, EV to EBITDA, all the metrics that people had used. So in the 1990s, what did analysts come up with as metrics to compare dot-com companies? Website, market value per website visitor. Until Mary Meeker looked at it and said, that's not sophisticated enough, because some people come for only 2 minutes to your website, some people come for 10 minutes. She computed a market value per eyeball. I'm not kidding. She took the market cap of every company, divided by the number of minutes people were on their websites, and came up with market value per eyeball. You think, what's wrong with that? If I asked you to pay 5,000 times earnings for a company, would you balk? You said, that sounds high, right? Because you have some frame of reference. Typical company trades at 20 times earnings. How about 500 times revenues? You're saying that sounds like a high number. If I asked you to pay $300 per eyeball, you think, I like my eyeballs. $300 doesn't sound like much. You have no frame of reference. When you have no frame of reference, you can pay absurd prices and not even recognize it. But in the dark side, that's what you will see. Market value per subscriber, market value per download. And you have no frame of reference. You say, that doesn't sound high. How do you know what's high or low if you've never seen it before? So in the 1990s, when I used to do these valuation seminars, it was a peak of the dot-com boom. At the end of the seminar, a particularly aggressive member of the audience would come up to me and say, you really cannot value Amazon.com using a DCF model, can you? They'd have this finger going like this, please step back, you're going to hurt me. And at the risk of grave personal injury, I'd say, yes, you can value Amazon using a discounted cash flow model. And they'd give me this look of total contempt and say, academic, and walk away. It's not meant as a compliment. Basically, academic basically meant you really can't value these companies. You can just talk about them. So after about the 5th or 6th time of being called an academic, I got pissed off. I said, you know what? I'm going to value Amazon.com. 1997, I sat down to value Amazon. And here's what I ran into very quickly. There was nothing in the literature on how to value a company with small revenues and big losses, because everything in the books was written for mature companies. Put in a growth rate, use a sustainable growth equation. Nothing worked. But I persevered. And I kept a journal. And every time I ran into a roadblock where nothing in the literature worked and I came up with choices, I wrote in the journal what I had to do to estimate growth and margins and reinvestment. And by the time I was done, that journal was 75 pages long. It's still on my website. It's called The Dark Side of Valuation. Can Amazon.com be valued? The answer is, but I'll give it away, is yes, but you'll have to get over all of these roadblocks. So what I'm going to do is take you back not to 1997, but to 2000, January 2000. And the reason I picked January 2000 is the peak of the dot-com boom. Amazon is the poster child for the, and I'm going to take you through a valuation I did in January 2000. And the reason I'm going to spend time on this valuation, you're going to see the seeds of your FCFF simple Ginzu spreadsheet in this valuation. It did not exist in 2000. So the first version showed up in 2000 because I had to build it. So let me set the table. January 2000, this was actually one of the first webcasts carried by AIMR, which is the parent organization for the CFA. Any CFAs in here? So this is one of the very first webcasts. And in fact, it was in response. He came to me and said, would you be willing to do a webcast on valuing these dot-com companies? Everybody seemed to be excited about them and nobody seems to know how to value them. I said, yes. So I'll give you a compressed version of that webcast. So you're setting the table. At the time of this valuation, Amazon had revenues of $1.1 billion. Let me pause right there. A US retail company with $1 billion in revenues, big or small? Let's get perspective. What did Walmart have as revenues last year? 500 billion. Costco is like 50 billion. Even if you go back to 2000, you looked at a medium-sized retail, the Gap at 22 billion in revenues in 2000. 1 billion is a tiny retail company with operating losses of 410 million. So it's got small revenues and big losses. I'm going to ask you a very simplistic question. Humor me anyway. Can a company with small revenues and big losses become a valuable company? Let's hope so, right? Because every company at some point in time is a company with small revenues and big losses. Help me out and say simplistic. What has to happen to the small revenues over time for it to become valuable? They've got to become big revenues. What do I need for that? Revenue growth is my mechanism for getting from small to good. What's going to happen to the losses? Not just reduce, but they change sign, right? Otherwise you're stuck. So the losses have to become profit. So what do I need? I need a margin that I can aim for where I can say, once you get past the pain, this is what my margins look like. That's a target margin. Revenue growth, target margin. Two of the inputs that I ask you. And there's one final loose end, and I'll talk about that loose end in a minute. But in the case of Amazon, let me show you what the growth and margins I assume. Then I'll reverse engineer and tell you how I came up with the numbers that I did. For the revenue growth, I assumed a compounded annual revenue growth rate of 42% a year. I told you it was one of the first webcasts that AMR did. I hadn't even finished saying this when the first question rolls in. How come you're being so pessimistic about future growth? What am I doing to revenues? I'm starting with $1 billion, I'm making it 40 billion. I'm increasing your revenues 40-fold over the next 10 years, and you're accusing me of being pessimistic? You know why it sounded pessimistic, right? What were they comparing the 42% to? Revenue growth in the most recent year for Amazon was 200%. The question they were asking is, why are you going from 200 to 42? What they did not see was that's a compounded annual growth rate. My growth rate in year one is actually 150%. It scales down as the company gets bigger because it's going to get more and more difficult to maintain those high growth rates. I thought I was telling a pretty upbeat story. Now, of course, you can say, why 42? Why not 35? Why not 55? We'll talk about why it's a key variable driving the valuation. I had to come in and provide a story that backs into that 42%. Then I turned my attention to margins. Right now, their margins are minus 36.7. Let's do an easy question. If the margin stayed minus 36.71% forever, how much is Amazon worth? Zero. You'd have to pay me to buy Amazon. In my valuation, I assume that over time, those margins would converge on 10%. You're saying, where do you get the 10%? That was the 75th percentile of operating margins for retail companies in 2000, not online retail companies. You know why not? They were all losing money. I assumed that over time, the retail part would have to dominate, and I'd have to look at the margins for retail companies. Here again, I get pushback. How come you're being so pessimistic about margins? You know what the internal story was, right? You have online retail, they don't have the cost structure that brick and mortar retail companies should have. Therefore, their margin should be higher. And even then, I didn't buy that. And here's why. If online retailers have lower costs and higher margin than brick and mortar retailers, over time, what's going to happen? Everybody's going to shut their brick and mortar. Everybody's going to go online. They all have lower costs. If everybody has lower costs, guess what happens? The prices get lower, your margin shrinks. So I said, if you're a consumer, this is great. It means you have two places to go to buy everything. In the long term, I'm actually being optimistic, keeping margins where they are. Margins collectively for retail will actually decrease with online retail as an additional way for you and I to buy stuff. So again, another upbeat story, 42% growth, 10% margins. As I go through time and my margins go from negative to positive, and I'll explain why they take the pathway that they do, my losses become profits. Yeah.
Why did you start with total market share of the TAM? And then
If it had been younger as a company, I would have done that. And retail, when you think about total market, right? At that time, total market would have included everything from department stores to discount retail. So unlike total markets in other spaces where you have focus, total market in retail is everything or nothing. So you almost have to take a stand. So if you're a younger company going after a more focused market, let's say it's entertainment software, I'd start with total market and build down. But if you have a company with substance and you kind of see what it's doing, it's perhaps better to build off and make sure that the revenues you're giving them are not out of sync with what the total market looks like. So the total market will come into play, but it'll come into play when I check about should I use 42% or 55% or 30%. So it's implicitly there, just not explicitly there. So it's miraculous, right? I've taken this small money-losing company and made it into a large money-making company. It's easy to do on a spreadsheet, much easier than in real life. But you know, that's the nice thing about working with a spreadsheet. And it comes the final loose end. And this is the loose end I got stuck on the longest. To get your revenues from 1 billion to 41 billion, might be plausible. You're going after a big market. You have to reinvest, right? And every mechanism I had taught and written about reinvestment wasn't working. Let's try sustainable growth. What's the growth rate? Return on capital times reinvestment rate. What's the return on capital look like for Amazon in 2000? Big negative number. What does the reinvestment rate look like? Big negative number. You think this is very convenient. Big negative number times big negative number gives me a big positive number. But what the heck is a big positive number applied on a loss going to do? Just make the losses bigger. I took the CapEx and depreciation the most recent year and tried to do financial modeling. Disaster, right? Because depending on your base year, it can do good things or bad things. You can let it. So finally, after lots of trial and error, as I said, it took me almost 4 days to get there. I said, look, I've got to tie reinvestment to sales. It can't be to operating income. It's got to be tied to sales. Hence was born the sales to invested capital ratio. It still remains a mystery to a lot of people who do discounted cash flow value and down it for a little. What are you doing? I'm essentially, instead of tying invested capital to operating income, which is what you do with a sustainable growth equation, I'm trying to sales. And here, the sales to capital ratio of 3 reflects what retail companies collectively were generating as revenues per dollar of invested capital. Here again, the pushback was, shouldn't online retailers be more efficient because they don't need brick and mortar? They don't need brick and mortar stores, but guess what they need to reinvest in? Computers, technology, acquisitions. Those 3 assumptions allow me to come up with reinvestment and free cash flow. And you can see already that in this upbeat, optimistic story that I'm telling for Amazon, hey, take a look at my free cash flows. Minus 931 million, minus $1 billion, minus 90. So in my upbeat story, I have negative free cash flows for the next 6 years. Am I surprised? Not in the least. Why not? Because I'm being so optimistic. And this is one of the ironies. The more upbeat and optimistic you get about your company, the more negative your cash flows are going to be upfront, because you have to reinvest to get that growth. Now, to discount these free cash flows, I need costs of capital. The key word is, I use the plural, not one cost of capital. If you ever see a young company being valued with a single cost of capital, already you know you're on dicey territory, because if you're taking a company from a money-losing small company to a money-making mature company, you should expect your cost of capital to change. And if you look at my cost of capital, it starts at 12.84% for Amazon in year 1. Small money-losing company that can't afford to borrow money. Ends at 9.61% by the time you get to year 10. Large money-making company that's able to borrow money. You discount the cash flows back at the cost of capital, the value that you get for the operating assets is 15.17 billion. And I forgot the elephant in the room. Where's Nirvana for you? Right up there, the terminal value of 52 billion. And again, don't complain about the fact that the bulk of your value comes from the terminal value. It's a feature, not a bug, because when you buy young growth companies, that's like the price appreciation that you get from the stock. The present value you get is 15.2 billion. You add cash, you can see almost no cash. You subtract debt, almost no debt. You get a value for the equity of 14.8 billion. And then I subtracted out. Remember we talked about the option overhang? I subtracted options and I was floored by how much of my value had been given away by Amazon in the previous decade. And Amazon wasn't alone, because you had accountants telling you it doesn't cost you much, just give away millions. They took it to heart. The options they gave away took away 2.9 billion of my value. And I divided the remaining value by the value per share. I got a value of $35 per share. I thought I was in fact, I put no failure risk, because this was the peak of the dot-com boom. And it's how difficult can it be for a dot-com company to raise $1 billion? I've been upbeat on every single assumption. And the reason I emphasize that, the $35 I got was well below the stock price of $84. Now, when you value a company, remember at the start of the class, I said you value a company because you want to act on that value, right? So if I value a company, I valued at 35, it's trading at 20, and he asked me, what are you doing? I should be willing to say I'm buying, otherwise what's the point of valuation? And half my portfolio is composed of companies I've bought because of that question. I valued a company, somebody says, what are you doing? And I either have a choice of telling them I'm not buying and losing their attention for the rest of the valuation classes I'm buying. So ask me the analogous question here. Obviously, not asking me whether I'm buying Amazon. So what's the analogous question you'd ask here? My value is 35, the stock price is 84. Am I shorting? And I'll give you the answer that I gave on that webcast. I said, not in this lifetime. And the response was actually a natural one. He says, don't you have enough faith that I feel more strongly that Amazon is overvalued in January 2000 than I felt on pretty much any company that I found undervalued that I bought. But there I was willing to buy, and here I'm unwilling to sell. So what's the difference in January 2000 that led me to say not in this lifetime? It's not confidence.
Not knowing the duration of the market.
But remember that to make money, what do you have to do? You have the market price has to correct. So when I buy something undervalued, you ask me, how long am I willing to hold? My answer is as long as it takes. I'm not a portfolio manager. I don't have to answer to a client. I have to answer to myself, and I have a very forgiving client. So if need be, I've waited 6 years in some companies to make my money back, and I'm okay with that. But when you sell short, what do? You borrow somebody's shares and agree to return it to them. I knew this question was coming. You could see it coming a mile down. So before the webcast, I called around brokers to see how long they would give me on a short sale on Amazon. January 2000, you know the longest time the broker would give me? He said, you're a good client, I will give you 6 weeks. Now do you say, why? Even though I feel confident in my value, I'm not willing to act on it. Not only do I have to be right, but I have to be right within 6 weeks. This is one of the great asymmetries in investing. When something is undervalued, there is a bargain basement strategy, right? You can buy and hold and wait. When something is overvalued, there isn't an analogous strategy on the other side, which is long-term, which is at least easily accessible. I mean, things are changing. You can now have long-term puts, which you did not have in 2000, that you can get on a subset of very high-profile companies. You're able to sell short now for, 3 months, 4 months. In fact, I did sell short Amazon in 2018 or 19 for about 6 months. You couldn't do that in 2000. And then there are many parts of the world where you cannot sell short, period. It's viewed as something you cannot do. Which means if you have overvaluations, there's nothing really getting in the way of that bubble getting really big before it eventually it bursts. But you don't know when it'll happen. Yes, sir.
Do you ever find it useful to think about when the big dislocation between your intrinsic value and the market price? What has to be true for the price to convert variables?
Yeah, you can always, but you can solve for only one variable at a time. And that's always been the limits of expectations investing, which is Mike Mabus, one of my favorite authors' books is basically instead of valuing the company, is that why don't you solve for a variable? It can be growth, it can be margin, it can be sales to capital, it can be discount rate, but you can't do all 4. We'll talk about a more effective way of asking that what if question, but you can use the solver function in Excel with your spreadsheet to solve for any single variable, right? Basically solve for what that variable has to be for the value to be equal to price. It's useful because it tells you how much buffer you have on that assumption before your valuation starts to fall apart. So what I'd like to do is use that valuation to bring home some very simple lessons about valuing young companies I learned in the process of valuing Amazon. Remember I said, don't trust betas? That goes in spades with young companies. If you're valuing a snowflake, don't go look at the regression beta page. Because here's what you can see. In January 2000, when I looked at the regression beta page for Amazon, 2.23 was the regression raw beta, but there's the standard error, 0.50, which means the true beta for Amazon can be anywhere from 1.2 to 3.2. So what's the solution? What do we use when you don't trust the regression beta? Use a bottom-up beta. And in this case, I used 2 bottom-up betas. For the first 5 years, I used the average beta for online retailers, saying the online is the part that's going to drive in the risk of the business. But by year 5, I'm giving Amazon $15 billion in revenues and $1.6 billion in operating income. It's now a big retail player. I moved the bottom-up beta in the second half to the beta for all retailers. So that's why there's a big shift in betas from the first 5 years to beyond. Second, talk a little bit about how I came up with the numbers. In other words, you know what they say about what chefs say about kitchens. Don't come into the kitchen. You don't want to see me make the food I deliver, even at the very top restaurants. I'm going to take you into the kitchen, and it's not going to be an edifying side, because I'm going to tell you how the numbers came by. So let's start with the revenue growth rate of 42%. When I first valued Amazon, I did it the way I was taught to do valuation, which is sequentially. You know what that means? You do year one, then you do year two, then you do year three. And I decided that by the time I was to year three, I was pulling my hair out. I said, this isn't working for me. It was getting too uncertain. So that's when I stepped back and said, look, I can't project out individual years. There's too much uncertainty, too many things changing. So rather than go year one, year two, year three, I'm going to do something really strange. I'm going to jump to what I think this company will look like as a successful company. That's your story. So when you think about your story, the story you're telling me about what will this company look like if it succeeds? In 2000, when I looked at Amazon, I liked the company. I liked the way Jeff Bezos was running the company, and I thought would succeed. And I thought success would make it a pretty large retail company. You're saying, what does that even mean? I didn't know what it meant. So what I did was I went and downloaded, and this is the nice thing about a space like retail, which most of the big players are publicly traded. Download the companies. I looked at their revenues. I wanted to get a sense of perspective. What does a big retail company look like? The biggest retail company in 2000 was Walmart, I think 180 billion in revenues. I stopped and said, will Amazon end up as big as Walmart? And in 2000, my answer was probably not. It's not a discount retailer. Then I looked at a company like The Gap, 18 billion, and said, will Amazon end up like The Gap? And I said, probably going to be bigger. It doesn't sell just apparel. No. Almost by this process of going back and forth across the list, I decided, and this was my choice, to make Amazon the 6th largest retailer in the world. A large player, but not as big as a discount retailer and not as small as a special retailer. It's a story of success, but a success that in my mind at least gives them. So in 2000, guess what the 6th largest retailer had roughly as revenues? In inflation adjusted terms, about 40 billion. There's your secret. 40 billion is my end revenue because that's where I think they'd end up. You say, how do you come up with all of these growth rates? I just made them up. The growth rates are not the end game. The growth rates you have in your DCF valuation, that's not the number. The number you should be focusing on is the end revenues in year 10. Your growth rate is just a means for me to see how big you can make the company by year 10. So if you made a big issue with year one growth and said, I think it's going to be 163.33%, you can have it. You want year two, take it too. You give me the end numbers and the beginning numbers for this valuation. I control the value. It's that end story that drives valuation, not what you think will happen in year. And this is why this fixation, when young companies report earnings per share, strikes me as odd. I mean, the way investors react to the earnings per share announcement of a young company is like you having a kindergartner coming back with a report card and you take one look and say, you're never going to college. You might be overreacting, don't you think? Because this is a young company. What you're getting in the first 6 months is, unless it changes the end game, the story, your value shouldn't change that much. You're saying, what about margins? Well, what about them? I have the starting number, I have the ending number. When I first sat with the spreadsheet, all I had were blank cells between years 1 and 10. And I'm a lazy person. And I said, you know what? I don't want to be estimating margins in year 1, margins in year 2, margins in year 3. I set the spreadsheet on autopilot to fill in the numbers. Magically it did, but I had to give it some direction. So I want you to guess what the algorithm was that allows me to get these margins in year 1, year 2, year 3, etc. What do you think I did to come up? This is awfully precise. Minus 13.3, second decimal point minus. You must think, this guy must have an amazing margin predictor. What do you think the algorithm was? Nothing is complex. I mean, I'm a very simplistic thinker. No logs, no exponentials is a simple rule I follow. What's my starting point? 10. Minus 36.7. What's my ending point? Plus 10. What's the distance between the 2 points? 46. I've moved half the distance to my goal, which brings me to minus 13.35. I'm at minus 13.35. What do I want to be? Plus 10. I moved half. Why saying why half? Why not? I'll tell you, when I build spreadsheets, and I'd strongly suggest when you build spreadsheets, you try to do the same. I want to build a spreadsheet in a way where if people disagree with me, they can change the pathway quickly. You know what this app does, right? It moves me pretty quickly. Let's say you look at Amazon, you agree with everything else in my story, but you think their pathway to profitability is going to be a lot more rocky than mine. You know, all you have to do is take the half and make it a quarter. In other words, instead of moving half the distance, I move a quarter of the distance. Imagine what's going to happen to margins. I'm going to have more negative margins for a longer period before you turn around. This is the input that I've changed in your spreadsheet to convergence, year of convergence. Basically, I'm asking you, how smooth is your pathway to profitability going to be? If you think it's going to be really smooth, you can say by year 4, I'm going to be at my target margin. If you think it's going to take a lot more work and you say year 10, I'll end up with the same margin, but I'll have to dig deeper and lose more money before I get there. But it's a mechanism for capturing that part of the story. So as my margin goes from negative to positive, my operating losses become operating profits. Yes.
How do we go with the 10% for the terminal?
That is the 75th percentile of all retail companies. So basically, that's the advantage of having the cross-sectional distribution. I report only the average by sector, but if you wanted to get the margins for every company, you have Capital IQ, you can download the margins for every retail company, put up the distribution, and make your story work. Now, so just take the starting number and the ending number, take the distance, divide by 2. So if you take the minus 36 plus 10, that's 46.71. Divide by 2, that moves me 23.35%. That brings me to minus 13.35. Then you, for the first year. Now you're at minus 13.35, you're going to plus 10. The distance is minus 13.35, 10, it's 23.35. I take half the distance, it brings me to minus 1.68. So revenue growth, I just made up. The only rule I followed is higher numbers up front, lower numbers later. But as long as you end up with 40 billion in year 10, I don't care how you get there. And this is why I think angsting about will my revenues be 27% in year 3 or 25%, it sometimes distracts us from what the real end game here is. How big will this company get as a successful company? Oh, one final thing, if you look at those earnings, you notice that in years 1 and 2, I pay no taxes for obvious reasons. I'm losing money. In year 3, still losing money. Year 4, I'm making money, but I seem to be paying no taxes. How come? I keep track of your losses for the first 3 years. And this is the most effective way to deal with NOLs, is rather than keep them separate, incorporate it into your cash flows, because the only effect of having an NOL is the taxes will save you when you first start to make money. It's only in year 5 that I first start to pay taxes, but even in year 5, there's an NOL left over. And year 6, you get the full tax rate. So when you give me the marginal tax rate for a money-losing company, I will watch your NOLs for you. And if you have an NOL leading in, I'll keep track of that, use it to protect you against taxes until you run out of the NOL. And then I'll push you towards your marginal tax rate. Third lesson to keep in mind as you look at these young companies, especially with a lot of promise, you're saying, why do I have to stop in year 10? You'd be surprised how many people say, why do you stop at year 10? Why can't I go to, you can go to year 15. You can, I mean, in fact, that spreadsheet can be expanded to 20, 25, 30 years if, there's nothing difficult about doing it. But here's why I stop in year 10, and you can make your own judgment. This study that came out of Wharton about 20 years ago, which actually looked at IPOs. Okay? And IPOs is, in most cases, are companies at the peak of their growth. You go public when growth is peaking. And they look at the revenue growth of these companies relative to the sector that these companies belong to. So 1 year after the IPO, we look at the revenue growth rate. It's 15% higher than the sector. You're saying, that's why I bought these IPOs. Look at how high the growth rate is. 2 years later, you track these IPOs. The revenue growth rate is about 7.5% higher. 3 years later, it's 3% higher. By the time you get to year 5, you can't tell the difference in the IPO and the rest of the sector. Growth fades quickly at companies. The median growth period for a US company is between 3 to 5 years. When I use 10, I'm actually at the 90th percentile of growth rates for growth companies. Are there companies that have grown for longer than 10 years? Absolutely. We can name them, right? Apple, Microsoft. What is the fact that we can name these companies tell you about these companies? That they're the exception rather than the rule? So if you feel the urge to add an extra 5 years, do so. But remember, if you value a company to be an exceptional company, you have no upside left for yourself as an investor. So I'm going to stick with 10, but it's easy to expand that out to 15 or 20. There's no technical reason why you can't do it. It's a purely investor reason. Now, sales to capital ratio is a neat way to estimate reinvestment, but I'll give you one reason you need to be cautious. When you use sales to capital ratio to estimate the reinvestment each year, which is what I've done, that becomes the change in invested capital each year. Mathematically, that's always true. So the reinvestment you put into your free cash flow to the firm is what your invested capital is changing by. You're saying, so what? If you look at the very bottom 3 rows of your spreadsheet, the valuation output, here's what I do. I project out your operating income based upon the assumptions on revenue growth and margins. I also keep track of what's happening to your invested capital with your sales to capital ratio assumption. If I divide the after-tax operating income by the invested capital, I come up with, let's call it an imputed return on capital. You're not using return on capital directly, but whether you like it or not, you're making assumptions about future return on capital with the assumptions you're making about margins, growth. You're saying, so what? In the case of Amazon, that imputed return on capital in year 10 was 20.39%. I took a look at that number and I was okay with it. Let me explain what I mean by that. The median return on capital for a retail firm in 2000 was about 17%. I was giving Amazon a slightly higher return, but I could justify it. It's an online retailer. It's a big player. It's going to be able to have competitive advantages. You know what I would not have been okay with? If that had been 200.39% in year 10. My spreadsheet is sending a red signal saying, you know what? You're not reinvesting enough. And if I'm listening, what should I do? I should go back and lower my sales to capital ratio. So there is a mechanism in your spreadsheet where you can track, am I reinvesting too much or too little? And that's why I keep track of your imputed return on capital. So you can use that signal to go back and tweak your sales to capital ratio. It's one more piece of input into what should my sales to capital ratio be in the future, is whether you're ending up with a company that you can live with, that you're comfortable with. Now, I talked about this at the start of the class, but let me re-emphasize. So these young companies, you're going to get negative cash flows. Those negative cash flows, in the case of Amazon, I have 99% equity, 1% debt, are going to come from equity issuances. And remember, these equity issuances, sometimes you never see. You know why? Because much of the growth for these young tech companies comes from acquisitions. And guess how they pay for acquisitions? With shares. So you don't even see it as an equity issuance to the market. You're saying, why am I not taking that into account when I can do value per share? Because it's already in there. If you look at the value that I got for Amazon, the value of equity that I got would have been $3.09 billion higher. Remember, I came up with 15 billion. It would have been 18 point something billion if I did not have those negative cash flows. I'm effectively knocking down value by 16% because of those negative cash flows. That's a dilution effect already factored into your value. And that's why I don't want to count it in the number of shares as well, because that would be double counting. Now, one of the lessons I didn't take into account in January 2000 that I've learned the hard way is, of course, in 2000, the dot-com boom bust, and we realized how quickly these companies could go from promise to nothing. There's failure risk. And that failure risk can be substantial. And this is a tough number to estimate, because when you get to the spreadsheet, you say, well, should it be 15%? Should it be 30%? So I've been looking for data that I can use to estimate failure risk. And the Bureau of Labor Statistics actually maintains a very interesting database of all startups in the US in different sectors that they track over time. So the way to read this, if you look across all companies, now, 1 year after startup, only 80% of these companies survive. So 20% die in year 1. And every year you can see the drop off. By the time you get to year 6, or in this case, year 7, only 30% of companies that started up survived to year 7. So a couple of things you learn. One is the failure rate decreases the longer a company is around. So if you're valuing a startup that just started up, the failure risk can be 60%. If it's been around 2 years, that alone adds to it. Failure risk is lower for larger companies than it is for smaller companies, simply because the investors have too much to lose. It's not that these companies are somehow better. But you have a $15 billion market cap, VCs almost have an incentive to keep it going. Failure risk varies across sectors. It's greater in sectors like technology, where you can walk away from your mistakes more easily than it's in manufacturing. So this is where I started my failure risk mission. And as I said, 2000 I did not factor in. 2001 I did. But I know if you look at your spreadsheet, I've also built in failure risk as a function of ratings. If you can tell me your rating for a company, I can estimate what failure risk there should be. It's a work in progress. It's a one number in my valuation where I'm working to come up with a better way of estimating failure risk. Because the young companies, it could be a huge factor in what your final value is. Because the higher the failure risk, the less chance there is that you will get to the elephant in the room, the nirvana number, the terminal value. And this is the 2019 update, and you can see what percentage of companies in different sectors make it through year 6, year 7. Yeah.
Mechanically, how are you computing the failure rate into the DCF? Is it like or expected?
I just take it today. I say, look, if I don't get to nirvana, I'm not going to get any of this value. So basically, I take it today. I say, okay, there's a 30% chance of failure. What percentage of value will you get? I get a choice. No, I say, is it because when you fail, you liquidate. When you liquidate, you either get a percentage of book value if you have a physical asset company, or a percentage of your intrinsic value if you're an intangibles company. So I attach that probability right now. I put a percentage of your interest. So if you do intrinsic value, I'm bringing in the intrinsic value, but I'm saying somebody buying this from you in a fire sale is going to pay only half of that intrinsic value, 25%. If you're really pessimistic, you can put in 0%. Okay. So that failure risk can also be used for things like nationalization risk, because in nationalization, the worry often is that the government will pay you half of what you're worth 1/4. So think of failure risk as any kind of truncation risk and what you will get relative to fair value when that happens. And it's like a decision tree. Basically, I say it's going concern, failing concern, that expected value. Yeah.
So you're not getting, you're not necessarily getting a zero value.
No, in fact, I give you a choice, and you can put in half of fair value, 25%. And if you're very optimistic, you might say, look, I'm a pharmaceutical company, I have a patent, I'm going to be able to get 80%, in which case the cost of failure will be very minor, right? Because you just sell the patent. But it's never going to be 100%. No, that's the essence of failure. So I finished this valuation and somebody asked me, is it possible that Amazon is worth $84 per share? Somebody must have owned the stock at that time. And I said, possible is such a weak word. And this is the expectations part. I said, there is a combination of revenue growth and margins that will give you $84. I can back it out. And the nice thing about a break-even table is you're actually allowing two things to vary. Right? So basically the shaded cells are all of the values that exceed $84. Is it possible that Amazon is worth 84? Yes. But I can't invest on possibilities. I have to invest in probabilities. One final point, and then I'll end the session. And here's one thing I can guarantee: if you're valuing a young company, you're going to be wrong 100% of the time. And that's okay. Because remember what I said at the start of this class, you don't have to be right to make money. You just have to be less wrong than everybody else. And if you get a chance, you can look at the and get back. I'll show you my forecast from 2000 or 2001 through 2010 with what actually happened over those years. And you can see how off I was on some of the inputs and where I was off, and how that has affected my valuations of Amazon in the years since. But I'll kind of hold off on that because there's the rest of the story here that I think we can learn from when you look at young companies. So we'll see you on Wednesday. Yeah.
Have you mostly invested in US stock?
I invest all over the world where I have undervalued companies.
I believe you base your decision based on evaluations. And what's the average time that you payback, like get your.
I have some companies I've held for 25, 20 years in my portfolio, which form, every portfolio has to have a core, which is companies that might be fairly valued, that I bought when they were undervalued, but I've left them in there. Companies like 3M, Coca-Cola, companies like Facebook come and go. Now, because they're the more swings there are in the price and the value, the more likely it is that a company will come and go from your portfolio, the more stable value and price become. So I bought companies that used to be young companies that have now become mature companies that stay in my portfolio.
Because you're back in the game and
They're-
undervalued.
And even if they're fairly valued, my bias is to leave them in there. Because as long as they're fairly valued, I earn a fair rate of return. I can't make everything in my portfolio be about chasing excess returns. Otherwise, I'm going to be chasing my tail every year. No, but I do revalue everything in my portfolio at least once a year. And if something is significantly overvalued, I sell it. No, and that's led to some companies, some Tesla I bought in June of 2019, I sold in January 2020, 6 months later, because it went up 400%. My value increased by 50%, but the price increased by 40%. So it really drives me. I don't come in with saying I have to have a long time horizon, because that I think is already an admission of failure in value. I come in saying I'm willing to hold for a long period, but I'm also willing to sell really quickly if the price goes up too much. Now, I don't like it when that happens because it creates more tax consequences for me. I prefer to be right in the long term than right in the next 6 weeks.
That's the part, like, I don't quite understand, like the tax considerations.
Because if you sell after 6 weeks, it's treated as a short-term capital gain. It's taxed as ordinary income. Long-term capital gains, you get a much lower tax rate. That's not true across the world, but in the US, short-term capital gains, I pay a tax rate closer to 40%. On long-term capital gains, I pay a tax rate closer to 15 or 20%. So I'd much rather wait at least a year, but in the case of Tesla, I could not wait. It was just gone up too much, and from a value perspective, I said, I'm putting too much risk by holding on to it.
Because I just starting to realize that your class is actually more of a, it's like a long-term investment philosophy.
Part of it, right? That's why you value companies. It's part of an investment philosophy. I mean, I'm saying value might be part of your toolkit. It might not be,
Right.
depending on what investment philosophy you take. If you get a chance, you go to my website. I have an investment philosophies class. It's a free class. So you can actually watch the sessions. It's about how do you pick a philosophy? What is an investment philosophy? What goes into it? What are the ingredients? Why would you pick a value investing philosophy versus a growth investing philosophy versus a trading philosophy? So it's a class about finding the philosophy that best fits you. So,